Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. Over the past few weeks, a story has emerged from one of the largest institutional real estate investors in North America. It deserves a closer look. At first glance, it appears to be a story about losses. The Teachers Insurance and Annuity Association has been around for more than 100 years. It was founded in 1918 by the Carnegie Foundation for the Advancement of Teaching. They have a massive real estate portfolio of $23 billion. Now, the association's real estate account has realized more than $429 million in losses from the sale of 15 properties, with 12 of those transactions closing below their original acquisition price. For many observers, that headline alone is enough to raise alarm bells. How does an institution with decades of experience, thousands of employees, and access to some of the best market intelligence and perhaps some of the best financing in the world lose nearly $500 million on real estate? That question misses the real story. The more interesting question is why the losses are being realized now and what those transactions tell us about the current state of the commercial real estate market. To understand what's happening, we need to go back several years. Between roughly 2015 and 2021, institutional real estate investors were operating in an environment unlike anything we'd seen in modern history. Interest rates remained extraordinarily low for an extended period. Pension funds, insurance companies, sovereign wealth funds, and private equity firms were all competing aggressively for a limited supply of institutional quality assets. The result was predictable. Prices got bid up, cap rates compressed, investors accepted lower and lower yields in exchange for the perceived safety of hard assets with the expectation of continued rent growth. In many cases, acquisitions were underwritten using assumptions that appeared entirely reasonable at the time. Debt was inexpensive, vacancy rates were low, rental growth was strong, and new capital continued to flow into the market. Few people expected that within a couple of years the cost of capital would more than double and entire segments of the office market would face structural changes in demand. And then the world changed. Inflation emerged as a persistent problem. Central banks responded with the most aggressive series of rate increases in decades, and suddenly the assumption that supported asset values during the previous cycle no longer worked. Financing costs increased dramatically. Buyers demanded higher returns. Cap rates began to move upwards. The mathematics of valuation, which had been working in investors' favor for more than a decade, started working the opposite direction. Across the industry, values declined. Some property types proved remarkably resilient. Industrial assets generally performed well. Multifamily properties in many markets continued to benefit from strong demand fundamentals. But office buildings were hit particularly hard as remote and hybrid work altered tenant behavior and reduced demand for large amounts of office space. So as these values fell, many investors found themselves facing a difficult choice. They could sell assets and recognize the loss, or they could continue holding the properties and hope the future market conditions would improve, and most chose the second. Transaction volume across much of commercial real estate slowed dramatically because buyers and sellers simply could not agree on pricing. And this is where the TIAA story becomes interesting. Unlike many market participants who've continued to hold assets and wait for conditions to improve, TIAA has been actively selling properties. These transactions provide something that market observers rarely get during periods of uncertainty. They provide actual evidence of value. Not appraisals, not broker opinions of value, not internal valuation models. These are actual transactions between willing buyers and willing sellers. And the results are telling. Of the 15 properties, 12 generated losses. Now, while the aggregate loss of $429 million represents less than 2% of the roughly $23 billion portfolio, the pattern itself is significant. These transactions suggest that repricing of commercial real estate that began in 2022 is working its way through the market, and that many of the values established during the era of very low interest rates was simply not sustainable once the cost of capital normalized. One of the most important concepts in institutional real estate is the distinction between mark-to-model valuation and mark-to-market valuation. Most large property portfolios are not sold every quarter. Instead, they're periodically appraised, and the valuation process involves assumptions regarding cap rates, rent growth, discount rates, vacancy, and future market conditions. And while these appraisals are often prepared by highly qualified professionals, they're still models, they're estimates, and a transaction is different. A transaction represents a point where a buyer is willing to commit capital and a seller is willing to transfer ownership. It's at that point the market establishes a value that's far more difficult to debate. And this is why the TIAA sales are so important. They're not simply isolated transactions. These are not forced sales. TIAA did not have to sell. One of the transactions that attracted considerable attention involved a Manhattan office building that had been acquired during those optimistic years leading up to the pandemic. At the time of the acquisition, the investment thesis appeared compelling. The building is on 9th Avenue, very close to Hudson Yards, and the Hudson Yards district was expanding. Tenant demand was strong and capital was abundant. The future appeared bright, and then remote work arrived. The office sector has been forced to confront a reality that very few anticipated. Many companies discovered they could operate with a lot less office space than previously. Leasing demand weakened, vacancy increased, investors began to reassess the long-term value of many office assets. And you have to remember the size of the New York market. There's more than 100 million square feet of vacant office space in New York City. That is a staggering number. There's very few markets that have even 100 million square feet total, let alone 100 million square feet vacant. An increasing number of property owners are starting to recognize that the current market conditions is the new normal. Every institutional sale becomes a comparable transaction. Appraisers review those sales, lenders review them, buyers review them, and investors review them. Each completed transaction contributes to the process of price discovery. That's one reason why commercial real estate transaction volume slowed so dramatically over the past several years. Sellers were anchored to yesterday's values while buyers were steadily underwriting based on today's cost of capital, and that gap was huge. So the question is, why did TIAA choose to sell now? We haven't really talked about that. Some of it may have to do with the structure of the fund. The TIAA real estate account offers investors daily liquidity, even though the underlying assets are private real estate, which is inherently illiquid. Maintaining that liquidity requires active portfolio management. The account specifically states it has to maintain liquidity to fund withdrawals, transfers, operating expenses, and benefit payments. So in an environment of falling values, the fund may be forced to sell something. The question is, out of the $23 billion in the portfolio, what makes sense to sell? Should you sell your best assets? They would generate the most amount of cash, but then again, they're your best assets. They're the ones that are going to deliver the best rate of return in the future. And then even if the weakest properties in the portfolio are not facing foreclosure or any kind of default, the big question is, should you sell those since they're the weakest performing assets in the portfolio? That appears to be what drove the decision. So for those of us who make investment decisions or finance development projects, maybe allocate capital into real estate, those transactions do provide valuable insight into where the market stands today. As you think about that, ask yourself a simple question. If every property in your portfolio were placed on the market today, would the values shown on the balance sheet match the values that buyers would actually pay? As you think about that, have an awesome rest of your day. Go make some great things happen. And we'll talk to you again tomorrow.